Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Investing in Dividend Stocks. And today, I wanted to talk about the 9 raises that our example paper money portfolio has received so far in 2026. Yep, 9 of them. And I really want to talk about the power of compounding dividends. I think this is going to be a really interesting discussion. Not a topic that comes up a lot. It's one of the more subtle things that can just go on in the background of a dividend investing portfolio. But we're going to be looking at some interesting numbers today. Looking really forward to this. But before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out in YouTube. Hello there, Janelle and Eva, George, Rojo, Robert, Greg, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in our live stream audience. And if you'd like to be here, this is a Thursday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that my very good friend Brent Moores is hanging out in the chats with us today. Brent and I have been working together for more than 2 decades. Brent brings a ton of experience to this. So what he's going to be doing is keeping an eye on questions that come in chat. And if I can't get to those, he's going to be sort of picking up the slack there for me. So thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening either live or on the archive to follow us on social media. You can find and follow your favorite Schwab presenters on X or on LinkedIn. So to find and follow Brent on X, just go to @BrentMooresCS. That's his handle there. Mine is @CameronMayCS. And you can also pop over to linkedin.com/in/CameronMayCS and find and follow me there. But let's get into this discussion. And of course, as we do, dividend investing carries risks like other market approaches. So bear these important disclosures in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So the agenda for today, as we do each week, we're going to take a quick look at what's going on with the markets through that dividend investor perspective. Then we're going to see what's happening with our example dividend portfolio. I think there's definitely some interesting things to be discussed there. But as we go through that portfolio review, that's going to lead us to our discussion of this compounding effect of dividends. And it's something that can happen kind of subtly, but it also can happen relatively quickly. I think some of you are going to be surprised as we're reviewing our example paper money portfolio today. But I'm going to be talking as we go through that discussion of the compounding effect of dividends, 4 key numbers that a dividend investor might want to be aware of. And then we're going to be planning and placing a new example dividend stock investment in our example portfolio. So let's go right to that portfolio. And we'll start off with a review of market conditions. Kind of a rough day for dividend investors. You might be thinking, well, aren't stocks doing well today? Yes, a lot of stocks are. Some stocks are not. And I will say actually dividend stocks taking a bit of a step back. And it's very likely related to the competition. That's what I refer to the long-term bond yield as being. So when we're out there allocating example cash for income purposes, there's a number of different asset classes that an investor might look for income from, including dividend-paying stocks, but also including, let's say, bonds. So if bonds become comparatively more competitive on their yields versus, let's say, or the interest that they're paying versus the yields achievable through dividends, there may be more enthusiasm, more cash flow toward bonds. You may see that pull away from dividends and drag those prices down. It seems to be what we're seeing a little bit of today, because the Fed just announced that they are not changing the Fed target rate. I don't think that was a huge surprise to a lot of investors, but the markets have reacted What's looking more and more likely is a Fed rate increase sometime down the line. Certainly not guaranteed. The Fed can do what it wants to do. But yields have been going up, making potentially bonds more attractive, just on a relative scale, compared to maybe where they have been in the past against dividend stocks. And so yields are going up. At the same time, what we've seen is a big drop in dividend stock prices just today. Let's have a look at that. The index we use to track, and by the way, if you're not familiar with this chart, symbol is TNX:CGI. This is essentially the 10-year bond yields right now about 4.66%, coming up from down below 4% just earlier this year. So yeah, those yields are up fairly substantially. So if we look to see what has been the impact on dividend stock prices, dividend stocks have actually still had a good year, just not a good day today. So here's the index that we use to track the dividend stocks. Symbol is SPHYDMUT. SVIDMUT is how I phonetically pronounce that. It's not how anybody else does. I just do it to be kind of silly. Eva's still looking forward to that September meeting and saying, I think they will increase rates the next meeting. You're guessing. That seems to be sort of, I think that there appears to be a somewhat, not entire consensus, but it seems like attitudes are definitely leaning in that direction. Time will tell, right? We'll see. But in any case, what's going on with dividend stocks? Look at that drop, that setback that we have today, down about 2.1%. right now, very likely largely in response to increasing yields. Now, obviously, there can be other factors at play here. Dividend stocks carry their own driving mechanisms for price movement, but yeah, we're down about 2.1% today. Now, a dividend investor with a long-term perspective almost certainly doesn't care about these day-to-day fluctuations. It's probably not, it's very likely not even on their radar, but we still like to get some context for what's happening in our portfolio so we can sort of learn what's happening there so that we can kind of explain to ourselves what we're doing and what the potential influences on the outcome of our decisions might be. But dividend monarchs is what we're seeing here. If you're not familiar with the dividend monarchs, these are companies that have been paying and increasing dividends every year for the last 50 years. They also are required to be component companies of the S&P 1500. So that's what's being charted here. It's an index of those kinds of stocks. Then are seeing a bit of a setback after hitting recent highs. So how has our portfolio been doing? Let's go have a look at our monitor tab. Right now we have 18 dividend stock positions. Let's do a quick check-in. So the way that we've been allocating this, we're managing an example paper money portfolio of $200,000. And we're initially allocating 5% to each position across as many sectors as we can find qualified stocks in. Now, qualified, I'll explain what that is a little bit later. But so far we have 9 of the 11 sectors represented, and each of these 9, so we have 2 where we have no investment yet, but in each of these 9 we have 2 stocks. So basically 10% of our portfolio is in healthcare, 10% of our portfolio is in consumer staples, doing 5% each in 2 different stocks. So we have some diversification there. Diversification is not a guaranteed reduction in risk exposure as markets pull back. But we also have been emphasizing yield. Average yield in a dividend paying company in the S&P 500 is about a little bit more than 1%. Our average yield, let's see, I ran the numbers this morning, about 3.22%, just about exactly what it was last week. Probably gone up a little bit as prices have fallen today. That's what happens. As prices come down, the yield on those prices goes up. As a spoiler alert, that's one of the 4 key numbers we're going to be looking at a little bit later today. We have beta as a gauge of our volatility of the stocks within our portfolio. A lot of dividend investors don't like to see stocks jumping all over the place as they're waiting for those dividend payments to arrive in their portfolio. So we typically look for beta scores of around 1, maybe a little less, maybe a little bit more. That would just mean sort of average volatility stocks. How's the portfolio doing overall? Well, we're up 9.81% as of this moment. You'll see that change. But this is since it's actually just bottom line. How has each stock done? We just tally that up and divide by 18 basically. So up 9.8% right now on the portfolio, which is not too bad considering we just started building this portfolio in January. So one of these stocks we purchased right at the start of January. Another stock we just bought last week. So on average, we've held these for about 4 months. So this you might think of as the current unrealized gain on about 4 months on average of investing. That's great. I don't have a problem with that. The S&P 500, I think, let's just out of curiosity, let's go have a look at the S&P. Let's see how it's doing this year, starting right from the open of January all the way up to today. Looks like we're up about 7.6% on an S&P sort of average stock. I don't know if you knew you could do this. Let me remove this drawing. But when drawing a trend line, as you start that drawing, keep your eye on this little box that's dancing around that trend line. That's telling us a number of things, but included in that is the percentage change from the start to the finish of that line. So up about 7.63%. So our portfolio is outperforming right now. It's been a kind of a good year for dividend stocks in general. That's not a guarantee that every year is going to go, or even that this one is going to continue this way. Judith is saying, is this a fund we can purchase? Are you talking about SVIDMT? The index we just looked at, it's not a tradable security. All right, but let's get back to this. So I will say, so we already have 9 sectors. The 2 remaining are communications and tech, basically. So we're going to be doing a scan today. We're going to be adding our first technology stock to our example paper money portfolio. But what I wanted to talk about before we get to that is this idea of compounding dividend yields. And there's something that's been happening in this portfolio already in 2026. So as I mentioned, we have 18 stocks, and we've actually seen the dividend increased on 9 of those since the date of purchase. So even for some that we purchased in, let's say, May or June, those have seen a dividend, some of them have seen a dividend increase. Of course, there are probably more that were more in January and February. But that increase, bottom line, can behave very much like a raise to our dividend investor. And I wanted to talk about, actually, as I was doing my research on which ones have done that. So it looks like our BG stock, ED, FAST, Johnson & Johnson, KMI, PKG, PNC, and Target, TGT, they've all seen an increase in the dividend since we bought those stocks. So 9 out of 18, a dividend investor might see that as a raise. So for example, we have one stock that when we bought it, it was paying a $1.70 dividend. It's now paying a $2 dividend. So George says, oh yeah, that is a good point. And thanks to Brent for pointing this out. I'll go right to that, George. George says that Brent pointed out that the dividend is not included in your profit or loss. Yeah, that's true. So this 9.8% growth is just price growth. Actually, price growth is sometimes negatively impacted by dividends. We know that on the ex-dividend date, price is adjusted downward by the amount of a dividend. And this is how much our stocks have essentially been able to accomplish, we might say it this way, despite dividends. And what's been happening in the background here is we've also been collecting dividends, which are not reflected in paper money. Nobody's actually paying fake dividends to pretend accounts. So just for quick numbers, our average yield right now is about 3.22%. We've been invested in our average stock for about a third of the year, about 4 months. So if over the course of a year we might be anticipating about 3% yield, well, maybe we've gotten 1% of that. So bottom line, we have about 1% dividends that have been collected, 1% in dividends collected, in addition to the 9.85. So if we were looking at what we call the total return, we'd be around 10.85% total return. Yeah. Matter of fact, when we were looking at that chart of SVIDMET, we don't have to, by the way, you don't have to type the symbol in every time. One thing that you can do is just go to your recent right up here, click on the little drop-down menu, click on recent. There's the recent symbol. But in any case, this you'll notice has the initials TR. This is a total return index. So it's showing us how has the price of these dividend monarchs done over the last 12 months in this case, plus all the dividends that they paid. So that's the net change that we're seeing here over the course of the year. But yeah, good point there, George. Portfolio overall is up closer to 11%. All right. Now let's talk about what's been going on behind the scenes. I just mentioned we have 9 stocks that have seen a dividend increase, and I want to go through a couple. Patrick is asking about dividends and wash sale. Not really a concern. The wash sale rule is if you're in and out of a position within within basically the same day or so, right? Patrick, I would be surprised if we wind up selling any of these stocks. So that, regardless, much less getting in and out quickly. We're going to get in and probably not out unless something dramatic happens. If there's a dividend cut, for example, that might trigger a sale of the stock. Or if one of our stocks grows really big or actually shrinks quite a bit, we may do some rebalancing. That can lead to partial sale of shares, but shouldn't be a consideration. Yeah, and Eva, I don't get into whether that's a good idea or what the tax implications of investing, but that's the rule that Patrick's referring to there anyway. But let's talk about this compounding of dividends. So as a couple of examples here, we have PKG and PNC. So we have PKG right here. When did we buy that? We bought PKG on March 12th. PNC, we bought that a week later on March 19th. Both of those have actually been doing fairly well. So PKG is up about 11%. PNC is up about 24%. Both of those have seen their dividends increase. So let's go see where we can see that. If we go to our charts, let's bring up PKG, and we can see, so we bought them back here in March. So our first payment on PKG, theoretically collected in our paper money, was $1.25. That has been increased to $1.50. That's very consistent with the kinds of companies that we've been choosing to invest in. We've been looking at that long-term track record of dividends being paid. And so we just got essentially a 25-cent raise as shareholders on the dividend. That's in addition to how the price has changed. So I think on PKG, what did I say, 11%? Something like that. Well, I want to take a closer look at that. So there are 4 key numbers that I want to talk about. Oh, it says hello there. Hello, everybody. I just wrote that in a different webcast just as a demonstration of how the Scratchpad works. But there are 4 key numbers that I want to discuss here, things that are going on as prices or as yields are going up. They're going to be these: the current yield, the initial yield, the yield on cost. In fact, let's make the O there capitalized, just that we know that that can be abbreviated to yield on cost. And then there's the yield on cost percent change. All right. So just to revisit a concept that we've discussed in the past, I do want to just talk about why dividends get increased. What's the driver there? Well, can be a number of things, but commonly the company has already made the decision, maybe as a corporate objective in an effort to attract dividend investors. their goal is to just increase their dividend every year. And they make a practice of doing that. And there are actually a number of companies out there. There are dozens of companies that have been doing exactly that for decades. Now, another thing that can drive dividends up is price. As a stock price goes up, what happens to the yield? The yield goes down on that price unless the company adjusts their dividend. So a company commonly will raise dividends as their stock price is going up. And what's very likely underpinning that increase in stock price? Well, certainly it can just be market fluctuations. It can be related to, let's say, the industry coming into favor a little bit more strongly. But over the long term, typically long-term price performance is driven by corporate performance. Is the company profitable, and is it increasing those profits? So if it has increasing profits on a year over year, on a long-term basis, they conceptually have that ability to raise their dividends. So a number of factors that might come into play for raising a dividend. Now, additionally, if they don't raise the dividend, it's kind of useful to think of it that way. If price has gone up, the dividend yield is shrinking. Well, now that company might not be as competitive for new investors looking for income. So raising the yield might make them more attractive conceptually to those income investors that they might be trying to appeal to. But at the same time, if they don't raise that if they don't raise that dividend, they may not be even attractive for current investors anymore. Maybe current investors will say, you know what, I can get more income on a percentage basis somewhere else, another stock, maybe a fixed income asset, something like that. So those are sort of the motivations for increasing dividends. And what we're seeing here is that whatever those motivations are, 9 out of our 18 companies have already seen an increase in the dividend. And that increase affects each one of these 4 variables. So let's talk about the current yield, also known as just the dividend yield. With PKG, if we were to buy it right now, it costs us $246.24. And as of this most recent quarter, the dividend was $1.50. So if we're trying to figure out the yield, if this company pays quarterly and this one does, we just multiply the most recent dividend by 4. So the assumption is it's just static. So let's get out our calculator. $1.50 times 4. I know you're all saying it's 6. It is 6. So $6 is how much we might expect to collect in dividends over the next year, having paid $246.24 for the shares to position ourselves to collect those dividends. So that's at about a 2.44% current yield. All right. Let's compare that to what we were originally getting when we bought the shares. So this is what a new investor would be projecting for a yield. It's also, if we were to just, as already investors, if we're just looking at today's price and saying, well, if today's price were to hold, what kind of a return are we getting over the next 12 months, assuming our dividends are consistent? Well, what was the initial yield? Well, we bought this back in March, and then we collected $1.25. How much did we pay for this in March? So let's see, this is PKG. So we bought this. I might need to hide this left column here for just a moment. We paid a trade price of $220.67. Okay, so $1.25 is what we initially collected on 220. Did I say 67? Yep, 220.67. So our initial yield, oh, nope, I didn't. I skipped one step. Did you catch me? Sometimes in explaining this, I can miss the obvious. $1.25 times 4. There we go. So $5 would have been what we might have been expecting over 12 months back in March. And actually that's been stepped up to maybe $6 for the next 12 months. But $5, our yield back then at 220.67 cost, 2.27%. So this is interesting. So the current yield, a little bit stronger. The company's raised that dividend. It's essentially trying to keep things at least static for new investors and potentially to reward existing investors. But here's what's subtle. Our yield on cost has gone up. So for current yield, we take the dividend, the annualized dividend divided by current price. For the initial yield, we take the initial dividend annualized divided by the initial investment. Yield on cost, what we're doing is just looking at, okay, how much are we earning if we're projecting $6, but we only invested originally $220.67. Let's do that. $6 divided by 220.67. We're now looking at 2.72%. That's very interesting. So when we bought this back in March, we were looking at, okay, on the cost of those shares, we were expecting about a 2.27% return. At this point, it's 2.72% return. That's up almost 50 basis points. That's about a 0.45% increase just this year. How much of an increase is that if we're sort of valuing our dividend, our income, as the reason for investment? Well, a 0.45 increase on an initial 2.27 yield means that our dividend is already 20% larger versus what we paid for the stock than it was back in March. Big increase. We could have just done that. We could, if you want to see the change, the yield on cost percent change, in this case, it's about, what did I say, 19.8%. And let's put in, let's do this. Let's put in a plus so we can emphasize that this was a positive yield on cost percent change. It is possible that a company cuts its dividend. In this case, they've raised the dividend. What I was going to say is we could have done this as well. We basically seen a 0.25% or a 25-cent increase on a 125. Is that what it was? Yep. 25-cent increase on a 125 previous dividend is about 20%. Yep, another way that we can calculate that. But in any case, that's a big deal to our would-be dividend investor. And that is in addition to the reason for the increase of dividend, which is very likely the price has gone up. So we get price appreciation, we get yield compounding, an increase. Larger paychecks, basically. Paycheck is the wrong way to put it. Larger dividend. All right, so what else has been going on? I did want to look at one more example. I hope you don't mind me abusing you with that. Let's have a look at what we're going to look at, PNC. So PNC, when we bought it back in March, it was paying $1.70. You can't see it. It's kind of disguised back there. If you point right at the dividend icon, we can see it was $1.70. It's now $2. So that's a pretty good jump in the dividend being paid. So what would that give us as a current yield? Just get some repetition. $2 times 4. So this is projecting how much we might anticipate to be collected in total dividends for the year. That'd be $8 divided by the current price of $248.66 would give us a current yield of about 3.21%. The initial yield was $1.70 times 4, which was $6.80, and we originally paid $200.40 for these shares. So our initial yield was 3.39. Notice our actual current yield has gone down. Oh no, it's a disaster. Well, it's still relatively consistent. We've gone from 3.39 to 3.21, but we're not a new investor. We already bought this thing So what's our yield on cost? So we have, what was it, 680? Annualized yield, divided that, let's divide that by not annualized yield, but annualized dividend collected. $6.80 divided by $200 and, oh no, I'm sorry, we increased it to $8 annualized. $8 divided by $200.40 is a yield on cost right about 4%. And so finally, what's our yield on cost percent change? We've gone from initial yield of 3.39 to 3.99. That's 0.6% increase divided by 3.39 originally. That's about a 17.7% yield on cost percent change. Very interesting to see how these numbers can add up. And boy, this is adding up just this year. It'll be interesting to see if these companies continue to increase their dividends. But that's why an investor might check the track record of the company to see if it has that history of increasing those dividends. So that's what we're going to do today. Let's go look for a new stock to add to our example portfolio. Let's do it in a sector where we don't already have investment. So we're going to be looking in, I'm just going to look at technology stocks today. And let's go over to our example live platform where we built previously a scan. Now, call me out. I'm going to try to remember to share this scan as we construct it. We're going to do a couple of minor modifications here and then run the scan. But we're going to use our scan query known as, let's go to our personal. It is our dividend working class scan. And so specifically, this scan is looking for yields between 2 and 6% on companies with a market capitalization of at least $10 billion with beta values between 0.5 and 1.5, so sort of average, a little bit below average to a little bit above average volatility stocks, and long-term debt to capital below 50%. Okay, that's what this scan was built to look for. And right now we're scanning in the S&P 500, but I don't want to scan in the entire S&P 500. Let's direct this to a specific sector. So we're going to go down to intersect with the, what did I say, the technology sector. So let's select all information technology. We're going to scan through that sector, look for the companies that are yielding between 2 and 6%, $10 billion companies with a beta around average, and debt loads that aren't terribly high, at least according to this metric. And let's run a quick scan. Now, as I do that, let me do this while I'm thinking about it. I'm going to click on this little menu right here and let's share the scan. And how about we call this, let's call it our tech dividend scan. Let me share that. And I'm going to paste that into the chat window. And I'm also going to add it to my session notes so that I remember, for those that are watching on the archive, you can just go down into the video description and find that scan down there. There we go. And I'll just say, I'll just label it something like my tech dividend scan. Here it is. Now, when I share a link like that, what you'll do with that is come up here to the little gear icon. It'll look like it's a browser URL, like an internet URL, HTTPS. It's not. Don't try to go put it in the internet. Instead, you'll go right up here to the little gear icon, and we're going to open shared item, pop it in here, click preview, click import, and then that will be added to your personal scans. So we can then just load it just as I did this one right up here. In any case, looks like we have 3 S&P tech companies that meet all of these criteria. So as a recap from previous webcasts, I usually write these out. I'm not going to do it today, but we have an example set of priorities for investment in this webcast series. Yield is our first priority. The consistency of dividends being paid, making sure that they're increasing dividends over time, or at least, at the very least, consistently paying a dividend, not cutting that dividend. A third priority is the debt that the company carries. High debt loads tend to represent a potential threat to the company's ability to continue paying a dividend. The volatility of the stock. If you get a really choppy stock, it can be kind of a roller coaster ride between one dividend payment and the next. The net performance of the stock over a long period of time, because if price is contributing along with dividends, that's great. If we're collecting dividends, but the stock price is consistently going down, it's just a money-losing proposition, even with the dividends hoping to help. And that's, oh, and diversification. So we do try to allocate across a range of sectors. So there we go. We've accomplished quite a few of those objectives just with our scan. But one that we haven't addressed is, well, two, the consistency and the performance. How consistent has the company been with paying their dividends and increasing those dividends? And how has the stock actually performed outside of the dividend? So let's go have a look at some of these. So we have Texas Instruments, we have Accenture, and we have Cognizant. Let's go look at those on a longer term chart. And let me just hide this left column now. Let's bring up Texas Instruments first. TXN. So here's a price chart of TXN. I'm going to pop up here, change this to a long-term chart because our dividend investor very likely has a long-term outlook, doesn't really care about day-to-day or even week-to-week fluctuations in price. But over the long term, price has actually been doing well. But this chart does not reflect all of these dividends that have been paid. So I'm going to make that adjustment to the chart in just a moment. But one other thing I'm going to check is let's just do a quick flash check of what's been happening with the size of the dividends being paid over time. So back in 2017, it was paying 62 cents and then at 62 cents and 62 cents. As we move forward in time, 77 cents, 90 cents, 102, 124. Do we see a pattern here? 130. That's how quickly we can just sort of check the consistency and check to see if that dividend is regularly being increased over time. So that one sort of ticks that box. So consistency is there over at least a 10-year period. Performance is there, but let's adjust our chart so that we're seeing total return, price plus dividends. And I like to do this. Let me remove this drawing right here. And I'm going to draw in a trend line from back 10 years ago to where we are right now. That just sort of gives you a visual reference point for what price has done. But if we build in dividends, let's click on the little gear icon. This is a stock or an equity. So I'm going to go to equities and I'm going to adjust the chart to also show all dividends. Let's click apply and click OK. And you can see dividends have contributed quite a bit here. This little difference between just price, it represents the value of all of these accreted dividends. So Texas Instruments, potential candidate for addition to our portfolio. Let's look at our other ones. We had, let's see, Cognizant. I can't remember what the other one was. I'll have to remind myself. Cognizant not doing so well over that 10-year time frame. Really, even price plus all these dividends, and you can see the dividends, you can see in this case, it's visible, 15 cents, 20 cents. If you squint, 22 cents, 24 cents, 27. So the company's been raising its dividend, but the stock has been kind of struggling. Now, for some investors, they might still be okay with that. Even though we're not net up over the last 10-year stretch, they might look and say, well, maybe price is at least down near 10-year lows, and possibly it'll go back up toward 10-year highs. Is that a guarantee? Of course it's not. But there's Cognizant. So start to weigh in your mind, well, which one might I choose? Texas Instruments or CTSH? And finally, what was our other one? It was, oh, Accenture. I think Accenture might be slightly positive, a little bit positive over the last 10 years. Let's see. Yeah, had a nice run. It's kind of gotten choppy and then fallen back. Maybe down to those lows. But how's the dividend done over time? 133, 146, 180, 188, 197. Looks like there was a cut somewhere in here, 120. No, no, no. No, I'm saying one. It was actually 88, 97. That's where I'm wrong. 112, 129, 148, 163. So yeah, consistently paying and increasing dividends. Which one do we think? How about, I'm going to do this. Executive decision. I'm going to take Accenture out of the discussion. Let's let you cast your vote for Texas Instruments or Cognizant. What do we think? Chat in the symbol that you think we ought to add to our example paper money portfolio today, and the first one to get 3 votes is the one that we'll add. So I have 1 vote is in. Let me bring up that other chart if it's helpful. Looks like, okay, we have, all right, everybody's voting for Texas Instruments. Did I type it wrong? Yeah, I got a 4 in there. All right, so let's go buy some shares of Texas Instruments to be added to our portfolio. And we're going to invest $10,000 as we always do. So let's go to our ask price. I'm going to click on that. Looks like we might be able to get about, what, 38 shares or something like that. Let's do some quick math here. If we use our calculator, we have $10,000 to spend. Divide that by around $280 per share. I don't mind the pennies. This will get us close. About 35 shares. Let's buy 35. Okay, so we're going to buy 35 shares of TXN. I am going to enter this, some prefer a more controlled entry. How about I say we're willing to pay up to, I don't know, $282 per share. There was a little bit of wiggle room there. When we put in a limit order, we're just saying this is the most I'm willing to spend per share. So I'm going to click confirm and send, putting in an effort to buy 35 shares of Texas Instruments for $282 per share or better or less is what we're asking for. We're certainly not guaranteed that this order will fill. That's a risk of placing limit orders. There's not a commission on this trade, but there can be on some types of trades. But we'll click enter. I think that'll probably fill pretty quickly. We're offering well, at least above the current market price. And we bought those shares for $280.35. And we've done it. With that, we've accomplished our objective today. I wanted to talk through the compounding of dividends. Not a lot of people out there. I kind of looked around YouTube to see what sort of discussions were being had. Not a lot to be found. So I thought that was a good topic for today. It's something that's already happening in our portfolio, and we're going to see if Texas Instruments can now add to that effort. Let's see, what did we get? We got about a 2.03% yield right now. Let's see if that grows. All right, everybody, thanks for giving me your time today. I'm going to let you go, but as you do, remember to take full advantage of the educational resources available to you from Schwab, starting with our YouTube channel. If you're new here, make sure that you're subscribed to our YouTube channel. It's called Trader Talks Schwab Coaching Webcasts. You just go down below the video stream, click on subscribe. It only takes a second, doesn't cost anything to do that. But this is where you can join our live streams. You can even find playlists of previous webcasts right here. I'm going to click on the playlists. And as we scroll down, what we're looking for is investing in dividend stocks. So there it is. I can click on View Full Playlist, and I can see last week's discussion, building a dividend portfolio for uncertain times. And we can see the investment that we made last week. So it's me, Laura says, are you doing a limit order rather than a market order just in case it spikes? Yeah, that's the concept typically for someone putting in a limit order on a stock trade. Obviously, it does come with risk. If the stock does spike, we may not buy it. And if it takes off, we don't own it. Yep. Patrick says, will you reinvest the dividends? Conceptually, I would for this portfolio, but there are no actual dividends hitting the fake account. So there isn't anything to reinvest. But yeah, that would probably be the decision I would make for this webcast series. It's always up to the investor whether they reinvest the dividends or if they take the income. But everybody also follow us on social media. You can find and follow us on X or on LinkedIn. You can follow Brent there on LinkedIn, on X, at Brent Moore CS. You can find and follow me on X at Cameron May CS, or you can hop over to linkedin.com/in and then /Cameron May CS is my handle there. So if you want to see what those platforms look like, there we are. There's my X profile. Here's my LinkedIn profile. And as I make posts here, if you reply to those posts, I just try to reply right back to you. So it opens the channels of communication when the webcast isn't live. All right, everybody, go enjoy your day. I will see you in a future webcast. Brent, thanks for helping out in chat. Thanks for all the thumbs up, everyone. That definitely is helpful and is appreciated. But I will look for in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.